Let's jump right into this explainer. We're looking at a pretty fascinating financial mystery today surrounding MI homes. Now, if you follow the housing market at all, you already know it's a sector full of wild, sometimes totally nausea-inducing peaks and valleys. But when you crack open the underlying financial data for MI homes, ticker symbol MHO, you get this completely contradictory picture. So today, we're tearing down their financials to answer one fundamental question for you. Is this company a hidden gem trading at a massive discount, or is it a classic value trap just waiting to catch unsuspecting investors?
Okay, we literally have to start with this staggering number right here, a 566.65% total return over the last 10 years. I mean, that translates to an average annual growth rate of over 20%. For a full decade, MHO has just been an absolute powerhouse of wealth creation for its long-term shareholders. Naturally, that kind of sustained, massive historical momentum puts a company on any serious investor's radar.
But here's the curveball. The current share price is hovering right around $121, with the stock actually down over 5% year-to-date. Despite the absolute historical dominance we just talked about, over the last week, 30 days, and year-to-date, the stock has just been flashing red. Actually, it's sitting roughly 23% below its 52-week high right now. So we've got a decade of outperformance crashing headfirst into a sudden wall of market pessimism. We have to ask, what is really going on right now?
Which brings us to Section 1, the fair value discount. Is MHO actually on sale?
You know, when a stock price drops like this, the very first thing we check is whether the business itself is broken or if it's just temporarily sitting on the clearance rack. And looking at these classic valuation metrics, a price-to-earnings ratio of 9.14 is objectively super cheap in today's market. But check out that price-to-book ratio of 0.97. That means you are currently able to buy M&I homes for less than the accounting value of its actual physical net assets. Compared to its own 3-year historical averages, the market is pricing its sales and its book value at a very notable discount.
To really wrap our heads around this discount, let's quickly touch on the margin of safety. Obviously, this is a crucial concept for value investors looking to minimize downside risk. Essentially, it's your financial cushion, right? If you calculate what a business is actually worth based on the cash it pumps out, and you can buy it for way less than that in the stock market, that gap is your margin of safety. It's what protects you if your initial calculations are a bit off, or if the broader economy hits a speed bump.
And man, here is that gap in real life. Based on discounted cash flow metrics, MHO has a massive 25.49% margin of safety right now. The underlying math, based strictly on their free cash flow, suggests the fair value price of the stock should actually be closer to $162. But because the market is only asking $121, you're theoretically snagging a dollar's worth of value for about 75 cents. On paper, this is a value investor's absolute dream scenario.
But let's put on our detective hats for a second. If a stock with this kind of killer history is trading at such a steep discount, why is the market pricing it so incredibly low? The stock market isn't exactly in the business of handing out free money. Usually, when a stock boasts a price-to-book ratio under 1 and a massive margin of safety like this, the market is actively pricing in some serious future trouble.
So let's look at Section 2, the catch, and specifically, slowing growth.
Yeah, here is where the buy-the-dip narrative hits a major speed bump. Take a look at the compound annual growth rate, the CAGR, over the trailing 12 months compared to their 3-year trends. While revenue is only down slightly, net income is down 33%, and earnings per share has plummeted nearly 36%. The profit engine isn't just stalling out here, the decline is actually accelerating.
But wait, it gets weirder. Strangely enough, despite that collapsing earnings growth, free cash flow growth over the trailing 12 months surprisingly surged by over 67%. Talk about a massive anomaly. How on earth does a company's net income drop by 33%, but its free cash flow shoots up 67%? Well, in home building, this usually happens when a company stops buying up new land and aggressively starts selling off its existing inventory. So they aren't making as much profit on each individual home, but they're pulling in a ton of cash just by liquidating what they already have on the books.
Let's move on to Section 3, the foundation, checking in on their balance sheet and overall health. Now, normally, if profits are dropping, a weak balance sheet could spell absolute disaster. But the news here is actually fantastic. MHO is incredibly solvent, a debt-to-equity ratio of just 0.30 and an absolutely enormous current ratio of over 12 means they are fundamentally rock-solidly healthy. Remember, the current ratio measures the ability to pay short-term bills with short-term assets.
A ratio of 2 is usually considered great, so 12.62, that is phenomenal. They are literally swimming in liquidity, meaning bankruptcy or a sudden debt crisis is virtually off the table.
However, even with that bulletproof balance sheet, their return on invested capital has dropped roughly 30% from its historical averages. Historically, MHO was generating nearly a 15% return on the cash it invested back into its own business. That has now slumped down to just over 10%. It really just proves that capital isn't being deployed as effectively right now, and the core business of building and selling homes is definitely becoming less lucrative for them.
And we can totally see this operational squeeze confirmed when we look at the margins. The gross profit margin is down to 24.83%, and the net profit margin has taken a nearly 27% hit compared to its 3-year average. Essentially, operating costs are eating up a much larger piece of the pie right now, leaving far less for the bottom line.
Which brings us to Section 4, the verdict, hidden gem or value trap.
Bringing all these clues together, we've got a serious tug-of-war going on between the balance sheet and the income statement. It's completely conflicting. On one side, the bulls look at that 25% margin of safety, the pristine balance sheet, and that massive cash generation, and they see a fantastic, low-risk bargain. But on the flip side, the bears are pointing straight at the collapsing EPS and dropping returns on capital, calling it a textbook value trap, a stock that looks cheap, but is cheap for a very, very good reason.
So as we wrap up this explainer, I'm going to leave you with this final critical question to guide your own research into MHO. Is that massive 25% margin of safety actually wide enough to catch the falling growth? Are you buying a fortress-like balance sheet on sale, or are you just trying to catch a falling knife in a contracting business? The numbers lay out the reality perfectly. Now it's up to you to decide which side of the equation holds the real truth for the future of M/I homes.